Now in week 1, part 3, we're going to do a preview of coming attractions of sorts. We're going to take a look at a European call option and how to price such an option using a binomial tree pricing model. And we'll also talk briefly about the Black-Scholes-Merton closed form formula that you can use for pricing European options as well. So a European call is just about the simplest kind of option that you can have. When you buy a call on some underlying asset, such as a stock or a crude oil futures contract or something of that kind, you specify the strike price above which you believe the underlying asset's price will rise over a certain period of time. When the so-called expiration date arrives, that's specified as part of the option contract, then if you were right, and if the price of the underlying asset is above the strike price at the expiration time, you collect money. But if you were wrong and the underlying asset price is below the strike price, then you collect nothing. This formula describing how much you collect at expiration time is called the payoff formula for the call. So we don't know the future. We may have convictions about what's going to happen in the future, but we don't know the future for certain. How much should we be willing to pay for an option that has this particular payoff behavior? Well, there are many different approaches to figuring out what the proper price is based on various assumptions about the market and about the behavior of the underlying asset. If our assumptions about the behavior of the market and the behavior of the price of the underlying asset are reasonable, then ideally it would be great if we could find a closed-end formula for the call price, because that's very likely to be the quickest way of getting that value. And in fact, for a European call, the Black-Scholes-Merton pricing model does provide us with a closed-form formula. Now, if the parameters of the option contract are defined in such a way that we can't find a closed-end formula, then there are various other approaches that we would have to try. For example, if we have a differential equation that describes the evolution of the value of the option, then numerical integration would be an approach to try. Statistical simulation is another very common approach, particularly for very complex option contracts. Another approach is to develop a binomial or trinomial or some other kind of tree that captures the evolution forward in time of the underlying asset price and therefore the value of the option to come up with an appropriate price to pay now for such an option. It's important to understand that all models of the financial markets are models of the financial markets. They're not the reality of the financial markets. And the question is, how good or bad are these models, and how much can we trust them to give us good information about how we should behave in the markets? Your other professors in future courses are going to get much, much deeper into the derivation of pricing models, the assumptions behind pricing models, how to test those assumptions, and so forth. Here in these last couple of weeks of FC1, I'm going to do a sort of hand-wavy job of describing these things and concentrate on looking at code that you can write to implement some models and compute prices for options. The Black-Scholes-Merton model assumes that stock prices follow a geometric Brownian motion. That is, that log returns of a stock are normally distributed around some constant drift or rate of return. In the closed-form formula for the Black-Scholes model, C of ST represents the call price of some stock at time t. N of X is simply the standard normal cumulative distribution function. C of S and T is the output produced by the formula. N of X is simply a formula that we apply. In terms of parameters that drive the formula and describe the option contract, K is the strike price of the call, T is the expiration time of the call. And these are simply parameters that are written into the contract. Other parameters are measured from the market itself. For example, the underlying stock price at a given moment in time is observed. The risk-free interest rate is observed and assumed to be constant, although that's only a reasonable assumption over a very short period of time. Similarly, the standard deviation of the stock's returns, the so-called volatility of the stock price, is estimated from observations of the stock price's volatility and is also assumed to be constant. We're also going to assume, for simplicity, that the stock is not paying any dividends between now and the expiration time t. All right, so based on these assumptions and parameters, under the Black-Scholes-Merton model, we have a closed-form solution for computing the call price for a stock with price capital S at some time t between now and capital T, which is given by the normal CDF of this factor D1 times the stock price minus the normal CDF of this factor D2 times the strike price discounted back from the expiration time capital T to the current time little t. All right, so in your options class and in stochastic calculus, you'll gain more intuition about how this formula works and even learn how to derive the formula yourself. To make our lives easier, we're going to be computing option prices at time 0, that is now. So little t is just 0 in everything that we're going to look at. Okay, so let's assume that we're looking at some stock whose current price is $50, and we're interested in buying a call with a strike price of $50. That is, we're hoping that the stock price is going to rise above $50 so that we'll collect some money from this option. The observed risk-free rate in the market is 10%. Actually, that's a good deal too high, but we'll just use that as an example. And the standard deviation of the change in the stock price, that is the volatility of the stock, is 40% or 0.4, which is actually a fairly moderate volatility. Let's assume that we want an option that expires 5 months from now, so that in an annual term, that's 0.4167, roughly speaking. Then we can plug all these values into this formula here on slide 5 and compute that the European call price of this option now, under the Black-Scholes-Merton model, is $6.12. Okay, so for a European call, if we believe that the assumptions in the Black-Scholes-Merton model are reasonable, and if we believe that we've been able to measure volatility and risk-free rate and so forth accurately enough, then this is a very quick and convenient way of getting a correct price. But the Black-Scholes-Merton model is not very robust to changes in the underlying assumptions or in changes in terms of the contract, like a flexible expiration time instead of a fixed expiration time. So let's take a look at another approach called the Binomial Tree, which is slower but a little more flexible than the Black-Scholes-Merton formula. Okay, so the Binomial Tree model makes use of what are called risk-neutral probabilities to determine, based on the same parameters as in the Black-Scholes-Merton model, what the relative probabilities are that the stock is going to rise in price or fall in price in a so-called risk-neutral world. The whole concept of risk-neutral behavior and risk-neutral probabilities is something that you're going to see much more of in later courses. At a surface level, we call a person risk-neutral if they don't care between a definite payoff of n dollars versus a statistical expected payoff of n dollars. Now, in fact, most people are risk-averse and would prefer a good sure thing to a possibly better risky thing. However, there is only one market, and consequently the fair price for this option has to be the same for each person in the market, regardless of how risk-neutral or how risk-averse a person might be. So we assume a risk-neutral world, we build our forward-looking tree of possible future stock prices, and then we can use what's called backward induction to start from the expiration time t. We compute what the actual payoffs of these possible future stock prices are at time t, and then we can step backward to time 0 to figure out what the option price should be right now. Let me give you one really quick idea of what a risk-neutral person versus a risk-averse person might be. Let's suppose that you're going to invest $1 with me, and I tell you you have a choice of two different investments. You can either invest $1 with me, and at the end of the year, I'm going to flip a coin, and regardless of whether I get a head or a tail, I'm going to give you back $1.05. So that's one possible investment. Now, the other investment is you give me $1, I flip a coin at the end of the year, and there's a 50-50 chance that I will either give you nothing back if I get tails, or I will give you $2.10 back if I get heads. So with the first investment, we can't predict the future of the world. We don't know whether I'm going to get a head or a tail, but we do know that you're going to get $1.05 back on your dollar. In the second investment, you're either going to get $0 back or $2.10 back with a 50-50 probability. So the average that you're going to get back, that is the expected value that you're going to get back, is $1.05. Now, a risk-neutral person would not have any preference for one investment versus the other investment. But most people are risk-averse and would rather definitely get $1.05 back than have a 50% chance of getting nothing back. And you may be thinking that that's not a very persuasive example. So instead of $1, let's imagine we're talking about $100,000. In one investment, you give me $100,000. I flip a coin at the end of the year, and I give you back $105,000. In the other investment, you give me $100,000. I flip a coin at the end of the year, and there's a 50% chance I give you nothing back, or a 50% chance that I give you $210,000 back. Well, now that we're talking about actual money, my guess is that you would really rather get $105,000 back as opposed to taking a 50-50 chance of getting nothing back, even though the expected value of the two investments are the same. A truly risk-neutral person would still be indifferent between those two possible investments. Okay, so the binomial tree option pricing algorithm requires the same parameters that the Black-Scholes model requires, with one additional parameter. That is, we have to specify for the binomial tree how many levels there are going to be, how many time intervals there are going to be in the tree. And the larger that number of time intervals is, the closer our computed price is going to be to what we would get from Black-Scholes. But the downside is that the larger n gets, the slower the algorithm runs. Okay, so from the parameters that we have, we're going to compute a bunch of helpful variables to simplify our code. Delta t is going to be the number of years in each time interval. This is simply the expiration time in years divided by the number of time intervals that we specified. The factor by which a stock rises, if it rises, is e to the sigma times the square root of delta t, where sigma is the volatility of our stock. This captures the geometric Brownian motion assumption that we have from the Black-Scholes model. If the stock falls, the amount by which it falls is e to the minus sigma square root of delta t. And you can see here that if a stock rises in one period and falls in the next period, it returns to the same price that it had in the initial period. That is, u times d is just 1. The risk-free rate factor, incorporating our risk-free rate, is e to the r delta t. And then the risk-neutral probability that the stock price will rise is computed as a minus d over u minus d. In multi-period asset pricing, you'll get a detailed explanation of the conceptual meaning and the mathematical derivation of this. Then the probability of a downward movement, of course, has to be 1 minus the probability of an upward movement. Now, at the top of our tree, the current stock price is S sub 0. And for each node below S sub 0 in our tree, we'll have some permutation of upward movements and downward movements. So at a given node at some future time in our tree, the price of the stock will be given by the price now times the combination of up factors and down factors. Okay, so in particular, let's look at the same example that we plugged into our Black-Scholes-Merton formula. We have an initial stock price of $50, a strike price of $50, a risk-free rate of 10%, a volatility of 40%, and 5 months until the expiration of the option. Our additional parameter that we're adding is that we're going to have 5 levels in our tree. That is 5 number of time intervals between now and 5 months from now. Okay, so from these specific values, we can calculate delta t, the up factor and down factor, the risk-free rate factor, the probabilities of an up move and a down move, and then we'll also be able to compute future stock prices based on today's stock price and some permutation of up and down moves. All right, so on slide 10, we have the beginnings of coding for a European call option class. The attributes within the call option class have to be specified when the European call option object is created. And these are the current stock price, the strike price, the risk-free interest rate, the volatility of the stock, and the future expiration time of the option. Each node in our tree is going to contain 2 price values. First of all, we'll have the stock price value, which we will compute going forward based on our up and down price factors. And then we'll also have an option price in each node that we'll compute using backward induction based on the risk-neutral probabilities of up or down stock price motions from the expiration time back to the current time. Now, because in this binomial tree model, the price change of an up move is the inverse of the price change for a down move, then starting from a given node, if we go up and then down, we get the same price as if we go down and then up. We can represent this as a list for each time step of lists for each sequence of up-down moves of these price node objects. And here's how that's going to look. Here on the left is the current time. The stock price will be S sub 0, whatever the observed stock price is now. And then we will construct our tree over 5 time periods by computing the stock price if the stock price goes up or if the stock price goes down. Then computing the stock price if the price goes up twice or up once and down once or down once and up once. Notice that going up once and down once is equal to going down once and up once because of the way our up and down factors are defined in this model. And then we have a stock price if we go down twice. Eventually, we get to time t, the expiration time, having taken 5 time steps. And this upper right node is going to contain the stock price based on going up 5 consecutive times. Likewise, the lower right stock price will be the price from going down 5 consecutive times. The nodes in between can be arrived at through several different up-down permutations. For example, to get to this node here, second from the top on the right, we could go up, 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 down, or we could go down, up, 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 or we could go up, up, down, up, and so on. So any combination involving 4 ups and a down is going to arrive at this node. Likewise, any combination involving 3 ups and 2 downs will get here, 2 ups and 3 downs here, 1 up and 4 downs here. All right, so let's form that as a list of lists, which is going to make our bookkeeping easier. And here is our list of lists. Binomial tree sub 0 is going to be a list of one price node object. That's going to contain the stock price and the option price at time 0 right now. Then binomial tree sub 1 is going to be a list of two price node objects. For the first time interval, that is 1 month in our case, because we have a 5-month expiration time and we've chosen to use 5 time intervals. So at 1 month, the stock price may have gone up or it may have gone down. At 2 months, the stock price may have gone down twice, or up twice, or up and down, or down and up. All right, so this middle node is what we have if we go down and up or up and down, and so forth, all the way to the final list of 5 nodes containing the stock prices and the option payoffs at the final time capital T. Okay, so here in slide 14, we're showing filling in the stock prices forward in our binomial tree. The current price of the stock is 50, and based on the up and down factors that we computed in the model, if the stock price goes down, it's going to be 44.55. If the stock price goes up, it's going to be 56.12. If the stock price goes down and down again, the stock price is going to be 39.69. If the stock price goes up and up again, it's going to be 62.99. And if it goes up and down, regardless of the order, we will find ourselves back at a $50 price. And so we can simply easily fill in the stock prices in our binomial tree following the formula that each stock price in the tree is given by the initial stock price times some series of up and down movements. Now, of course, in real life, if the stock price is $50 today and we wait for 1 month, it's exceedingly unlikely that the stock price is going to be either $44.55 or $56.12. Remember, this is a model of reality. It's not actual reality. And the model captures the geometric Brownian motion assumption that we used for the Black-Scholes-Merton model. We'll see that as we increase the number of time steps, this becomes more realistic and gives us a computed option price that's closer to the closed form formula, but unfortunately also at the cost of slowing down considerably. All right, so now that we have filled in our stock prices from time 0 out to the expiration time, we can also fill in the option payoffs that would occur for these various stock prices at expiration time. Remember that the payoff of the call option is the maximum of the expiration time stock price minus the strike, or 0. So if the expiration time stock price is 28.07, that's below the $50 strike and we collect nothing. Likewise, if the stock price at the expiration time is 35.36 or 44.55, those also are below the strike price, and so we collect nothing in those cases. But if the expiration time stock price is 56.12, we're above the strike price and we collect a $6.12 payoff. If the final stock price is 70.70, we collect $20.70. If the final stock price is 89.07, we collect 39.07. Okay, so in this model, after 5 time steps, we have 6 possible final stock prices, and we can compute exactly what the option payoffs are for those 6 final stock prices. But we are at time 0. We are not at time 5. So how do we roll back these possible payoffs at time 5 to get a single option price at time 0? Here's where the risk-neutral probabilities are going to play a role. All right, so in this node where the stock price is 79.35, what should we use as the value of the option at that point? Well, the value of the option at time t minus 1 in this situation should be the expected value of the payoffs of the options in the next step, discounted back by one time period. And the expected value is computing using our risk-neutral probabilities. So the expected value of the payoff is going to be the probability that the stock price goes up times the payoff if the stock price goes up, plus the probability that the stock price goes down times the payoff if the stock price goes down, discounted by one time period. And if we do that computation, we discover that for that particular node, if at time 4 our stock price is 79.35, then the correct option price at that point would be 29.77, the discounted expected value of the payoffs. The same formula applies at all the other nodes. So if the expected value of the payoff is 0, then the correct option price is 0, and so forth. You can fill all these in going from time I equals 5 all the way back to time I equals 0, and this gives us at time I equals 0, that is now, a calculated call price of $6.36. Now that price is quite a bit different from the $6.12 that we got applying the Black-Scholes-Merton formula. But again, that's in large part because we chose so few time steps to implement our model. Let's take a look at some code that implements this model. Okay, so here on slide 17, we had previously defined the init function for initializing a European call option object, and here is the beginning of our binomial price function. The European call option object has most of the parameters baked into it. To use the binomial model to calculate the price, we have to specify how many time intervals we want to use. Delta t is the expiration time divided by the time intervals. Here we have the up factor and the down factor, the interest rate factor, and then the risk-neutral probability of an up move in the stock price and of a down move in the stock price. Now, num intervals is a very long variable name, so in the rest of this code, in order to get things to fit on the slides, I'm creating an abbreviated name, ni. All right, so having defined values for our various parameters, the first thing we want to do is to create this binomial tree, that is this list of lists of price nodes that at the moment are all going to have 0 value. All right, so binom tree is our list of lists, and the ith row in this list of lists is going to be obtained by generating a price node with values of 0 for the number of cells necessary for that row. So for the first row, we'll just get one price node. For the second row, we'll get a list of 2 price nodes. For the third row, we'll get a list of 3 price nodes, etc. And we append those to the binomial tree. So at this point, we have our binomial tree, and it's filled in with all zeros. The next step is to fill in the stock prices, which we do use in the calculation that we described here on slide 14. That's what this first for loop does. And we can also fill in the terminal option node values, that is, the option node payoffs, at the bottom of the tree. And so that's what happens here on slide 15. Then on slide 16, we have to do backward induction. Aha! And this is where you have to do some work. And when we're all done, the call option price that we will have computed is going to be the option price attribute of the sub-zero price node at the sub-zero time. Okay, well that's that for the binomial tree model.